Good morning and welcome to the Global Perspective, a space where we tap into our expert fund managers from around the world for some insights into what's going on in markets at present. Today we have Ben Fitchew from Ardevora, portfolio managers of the Global Behavioural Fund, and one of the portfolio managers that have been running the portfolio since inception over 3 years ago this last week. Ben, thank you very much for joining us. Torrid times we've seen recently with this environment of stagflation and what's going on in the Ukraine. How's that affecting the way you approach investing and perhaps the biases that you use to extract alpha from investors and analysts around the world?
Yes, well, our process is built on understanding behaviour, understanding the behaviour of CEOs who invest capital and run business models, sell-side analysts who forecast and track businesses, and investors who obviously invest money and watch the behaviour of all of those other actors. And we spend our time analysing how CEOs allocate capital, what free cash flow comes out of their business model and what business models they run and how they talk about their businesses. And we watch forecast errors from analysts to see where their biases are, and we look to investors to see where they are rewarding surprise and disappointment in the market. And what we're seeing right now is very interesting behaviour, I would say. We're seeing in certain pockets of the market, we're seeing CEOs basically talking of recovery being very easy still. They're able to sell things very easily. Revenue is great, recovery is great. But we are also seeing that they are confused because they're not certain about demand, because we've had such an unusual setup with the pandemic and then the post-pandemic period. So they're not absolutely certain they can predict how consumers and other companies are going to behave around their buying patterns. And also they're starting to talk about how costs are increasing, either wage costs, pressures there, the cost of raw materials and components is going up. And so we have a lot of the talk of the late cycle, but it's very early cycle. So there's a confusion there, I would say, in aggregate from the CEO community about, this funny that we can see that, recovery in revenue is strong, but do we trust it? And yet at the same time, we're seeing this emergence of inflation, cost pressures coming through much earlier than you would expect. And then within CEO behaviour, we would say we see some interesting dynamics where certain areas of the market are seeing pricing power, and they are seeing an unusual ability to pass through costs, and they are seeing that they are suddenly getting demand and strong pricing when they've lived through 5 to 8 years of recession. And so they're not investing heavily because they've had such a difficult time for 5 to 8 years, and so we're thinking about energy and various commodities. And so those areas are seeing strong pricing power and strong operating leverage. Other areas which are slightly further down the chain, so not so close to actually producing the commodities, you say in the middle of value chains, are complaining more about costs and unpredictability, and so they're finding life a bit more difficult. So recovery isn't as simple as it was 12 months ago, but we're seeing this interesting dynamic where some areas of the market have sort of woken up in a way that they haven't been able to in the last 5 to 8 years. So that's sort of CEO, so management behaviour as we call it. Investor behaviour, we would also say, is confused and a bit anxious right now. They're rewarding certain types of surprises that we're seeing in some of those areas of like energy and commodities, and so those share prices going up when they get good news. But there's also nervousness and anxiety, increasing anxiety towards certain expensive sort of areas of the market, like tech and healthcare, as we've seen. Those share prices, despite good news, have basically gone down, and there's been a lot of pain there. And there's a worry about recession, even though there's demand is robust, and there's not much evidence of a recession, but there's a lot of talk about it. And so the market is sort of bifurcated into buying some of these areas of commodities where there's good news coming out, buying safe areas, those are defensive areas because of worries about recession, and then selling heavily in those growthy areas that had unusually sort of benign demand patterns during the pandemic. And so it's a confusing setup where everyone feels like it's late cycle, but it's actually so early, really, in a recovery from 2020.
And analysts, so sell-side analysts, people writing research reports on the businesses, how have they been reacting the same way to these surprises? It's not. It seems like it's compared to historically, it's a little bit different. So can you rely on that bias?
Well, what we're seeing is that you had an unusually high level of analysts being surprised last year,
right,
which is what you usually get in a recovery year, because usually people do not see recovery because recessions are unpredictable and the path out of them tends to be unpredictable. So, in 2008 and 9, you saw, lots of disappointment. No one saw it coming. And then lots of surprise in 2009 when the recovery comes. And so last year was an unusual year in the last 10 years because most companies were able to surprise. Life is getting a bit harder now, but it's not like a recession. It's more like a kind of going back to a much more normal level of companies able to surprise. But it's where that we are seeing surprise and where it's being rewarded has changed from the last 10 years. And so there's much less reward in tech and healthcare and e-commerce, those kind of areas where people have been increasingly comfortable and investors are rewarded surprise over the last 8 to 10 years, all those sort of growthy themes. And investors are beginning to get their heads around seeing, as they're rewarding big surprises coming through in these more unpredictable areas that have been areas that people have really avoided in the last 10 years. But to your question, analysts, they're still being surprised quite strongly in those areas, and that's where investors are rewarding it. So the pattern of surprise is interesting, but it's really how investors are rewarding that is the sort of particularly interesting feature of the current market, I would say.
Now, most investors in our funds, they appreciate fund managers being steadfast in their approach, but they also appreciate the fact that you need to evolve over time. So how has the last 2 years seen you evolve? I know there's a couple of areas that you've looked to approach differently, such as energy and banks. So would you just talk about that and how you've evolved your process in this current environment?
Yeah, well, so as you say, energy and financials, they're two slightly different sort of beasts, if you like, for us. We never invested in banks from the start of the fund, so when we started in 2011. And we kicked off a project about 3 or 4 years ago where we started to bring banks into our investment process because you need to treat them slightly differently because they don't generate operating cash flow in the same way and their balance sheets are structured differently from normal industrials or consumer businesses. And we've got into a position where we're able to bring them into the process in a way that meets how we think. And we started to buy into banks in April of last year because they have an interesting setup where for 10 years, basically, they've had to restructure globally. They've had to shore up their balance sheets. They've had to pull away from certain areas. There's been 10 years of restructuring. They then got whacked by COVID, so everyone was worried about a sort of a depression. So there was a lot of anxiety layered on top of the previous worries around the banking sector post-financial crisis. But actually they're in quite a low-risk state. And they're now meeting a situation where they have a chance of seeing interest rates go up and their net interest margin basically expand and therefore be in a slightly easier environment.
Easy growth. Yeah.
And so that's an interesting sort of juxtaposition of lots of legacy anxiety from investors, but actually a different setup on how management are behaving and how low risk the industry actually is. So we've gradually sort of increased our exposure to banks through the year. Energy is slightly different. We always invested in energy until 2020, and that was when we started to really think seriously about ESG. And we had taken the relatively simple view initially that actually the way you should think about ESG in terms of energy is that there's a lot of back-end loaded risk from climate change to their business models, and that we felt initially that it would be challenging to engage with them on basically their dealing with that externality. So would we be able to engage with them fruitfully on changing their plans so they could adapt to transition and to climate change? Now, having not owned them through 2020, which was beneficial to us because obviously the oil price cratered, what we've seen is that the debate in the market has moved on how you should deal with companies generally, I would say, in the fossil fuel extraction area. And we've started to think about whether or not the most responsible way to behave as an investor is really about owning and engaging. And so that's really where we've changed our view. And I think, obviously, the bare bones of our of our investment process is still exactly the same. We focus on management behaviour, how they allocate capital, and we focus on analyst and investor errors. But the thing that we have changed is our stance on whether or not it makes sense to own and engage. And for us, I think, and generally the market has moved on and sees that as the most responsible and fruitful way to deal with those companies and how you can deal with the transition and climate change. So that's where we've changed our stance. But I think it makes sense to us that that's logically the best way to deal with that area. And so now we've got some energy names in the portfolio, and so the shape of the portfolio has changed quite dramatically from pre and during the pandemic, I would say.
So I'm going to throw a question at you that we hadn't discussed beforehand, but do you have any views on the behaviour of central banks? Because they're obviously another actor in the whole environment, and we've recently seen a big change in the interest rates in the US that about prior to 2 days before, no one was expecting a 75-point hike, and now we're expecting another one. So do you have any thoughts on that and how that surprises the markets and people and how that affects the way you have to think about companies?
Yeah, in fact, actually, we would always used to say that our investment process was focused on 4 groups of people.
Oh, okay.
It's just that one we felt weren't predictable, if you like. So you've got CEOs, you've got investors and analysts, as you know, and we think about their biases, and we believe that they're, generally speaking, even though it's noisy, that you can find patterns of predictability in those to invest in. And there's this 4th group where that's not our skill set, if you like, and also that they tend to be unpredictable, which is the behaviour of the central bank.
Right.
And what we would say is that we could judge them by the errors coming out in the market. And so recently I suppose post financial crisis, you've seen that generally speaking, macro forecasters have believed that there would be more inflation than there was. So basically inflation has disappointed mostly. It's mostly been lower than everyone expected because everyone believed that all of the money printing post-2008 would lead to inflation. And actually, it hasn't. There's been scarce growth, and then that's led to structural growers to be revalued because rates have stayed really low. So we've had that that basically surprised everyone. We've now had an enormous amount of stimulus and even more money printing, and basically what we've observed is that the market is anchored on that last 10 years. They basically believe that we wouldn't get inflation. And so that has, as to your question, has really been the large surprise basically from December, because the Fed did not really believe that inflation was going to be sticky. They felt that it would go away. So really they were it was transitory, and they were anchored just as everyone else was. And so really we've seen our interpretation of that error is they're modelling it incorrectly. We've got the pandemic has shaken everything up. There's been a huge amount of stimulus, lots of cash sitting on consumers' balance sheets, and that has led to a highly unusual situation that isn't really in anyone's models for the last 40 years, and therefore the behaviour of these big macro variables has surprised everyone, particularly the Fed, and they've sort of woken up to it, and that's shaken the market. So what we would say is that essentially the model that the Fed had was biased. It was trained on the wrong environment for the current environment we have right now.
Yeah, I find that incredible, given the fact that you think about how much data they actually have, or information. They must have the most information of anybody out there in the world. How can they be behind the curve?
I think it's partly because it's about picking out, I suppose, the critical ones that are unusual rather than the mass of data, isn't it? So the things that look really unusual are the amount of cash on consumers' balance sheets, because that's at a sort of, it's completely anomalous. And then some changes in the structure of the employment market, where that we've seen some, particularly older people, have exited the employment market during the pandemic, and the effect of that was difficult to model because you don't have any other data points of that, and so it's difficult to model something where it isn't in all of your prior data, if you like. Even if you've got tons of data, if it doesn't have a pandemic in it, it's not going to be used to you.
Right.
I suppose, in a slightly facetious way, you can go back to some really, really long-term historical reference points like the Black Death and, in fact, Roman times when pandemics caused inflation. But it's quite a heroic investor who goes back to those reference points and says, I think that's like now, because it's a very different kind of setup. But that's that basic point when you've got an unusual setup and you don't really, even if you've got tons of data, but you don't have a good anchor point or reference point to frame your analysis, then you're likely to fall into error.
Okay, and lastly, 30-second answer from you, positive or negative on the equity markets from this point?
Well, it depends on your time frame. I think short term, probably a bit more pain.
Okay, great. Thank you very much, Ben. I really appreciate you joining us today.
Thank you.
Thanks. And to everyone watching, thanks for joining Global Perspective. Join us again next month. Goodbye.